Most of us are taught to play a specific version of the economic game. You earn a degree, secure a salary, and deposit the remainder into savings. For decades, this has been the accepted blueprint for security. However, the structural data suggests that while you are following the rules, the game itself is calibrated for a different outcome. The modern economy operates as a highly engineered flow of capital. It is a system of pipelines designed to move value through specific checkpoints, ensuring that wealth is consolidated as it moves through the network. To see how this affects you, we have to look at your primary engine of income, the 9-to-5 job. In the language of corporate accounting, an employee is evaluated through the human capex ratio, a calculation used to measure the cost of an asset against the value it produces over its useful life. This flowchart reveals the mathematical requirement of employment. For a position to exist, the worker's output must generate a significant multiple of their base salary in raw value. If your labor costs $5,000 a month, you must produce $20,000 or $30,000 in revenue to justify the overhead. The surplus value created is the true wealth. This excess value is the first major leak in your personal wealth-building engine. It is automatically routed away from your balance sheet and into the equity channel, where it compounds for shareholders and investors. Your salary remains linear, while the value you produce fuels a compounding engine owned by someone else. Trading a finite, non-renewable resource, your time, for a flat, linear paycheck is a structural guarantee of stagnation. Without ownership of the underlying machine, you provide the energy while the system retains the growth. The extraction continues after the paycheck is issued. We track the flow of your remaining earnings as they move into the traditional banking system. Historically, the savings account was seen as a safe harbor, a place to protect the capital you managed to retain. But the savings account is subject to a second mechanical drain, fiat liquidation. Central banks are structurally programmed to expand the money supply, a process that steadily reduces the value of every individual unit of currency in circulation. This chart captures the impact over time. While the nominal number of dollars in your account remains a steady horizontal line, real-world purchasing power experiences a slow-motion heart attack. A standard inflation rate effectively halves your cash's value over a career. To compensate for this melting purchasing power, the system offers a secondary loop, cheap consumer credit, allowing you to maintain your lifestyle by borrowing. The moment you use debt to purchase a depreciating liability, you enter the final extraction phase. Debt interest subtracts from your declining purchasing power, driving your net financial position towards zero. This creates a mathematical chokehold. You are working harder to buy items that are worth less, using borrowed money that costs more with every passing year. Between extraction at the job level and liquidation in the bank, the middle-class worker is structurally prevented from achieving financial independence. Reversing this flow requires shifting your identity. While a consumer allows their capital to be drained outward by the system, an allocator builds a closed loop that keeps capital within their own control. The 3 pillars of ownership provide the mechanical framework to reroute your money. Instead of letting surplus capital vanish into the banking system, you direct it into 3 specific pipelines designed to capture growth. Pillar 1 is broad market equities. By automating transfers into funds tracking the top 500 companies, you force corporate productivity to work for you. A fraction of their global growth is routed back to your node via dividends. Pillar 2 involves hard assets. Physical real estate acts as a shield. Because the underlying value and rental income rise alongside the expansion of the money supply, they completely neutralize the damage of inflation. Pillar 3 focuses on asymmetric bets. Allocating capital to digital scarcity, like Bitcoin, provides a growth factor decoupled from traditional systemic failures, acting as a high-growth insurance policy for your portfolio. Implementing this system requires no emotional engagement or complex market timing. It is a cold, mechanical process of automating your capital into these 3 pipelines. True allocators use the economy's own mechanics to build wealth. They utilize inflation and corporate productivity, forces that drain consumers, to expand their own balance sheets. The contrast between these 2 architectures determines your long-term reality. You are either the fuel for someone else's machine, or you are the owner of your own. Inaction is a choice to remain within the default structure. It is a commitment to the quiet, mathematical extraction of your time and purchasing power over the next 40 years. Breaking the cycle requires the execution of an exit protocol. This means spending less than you earn and mechanically automating every dollar of surplus into the 3 pillars of ownership. This approach requires the discipline to ignore daily market noise and allow compound interest to run its programming undisturbed for decades. Financial independence is the inevitable result of decoupling your income from your linear time and building an architecture that ensures capital flows inward by design.